Welcome to The Explainer. Today, we are opening up the Management Consultant's Playbook to break down one of the most fundamental metrics in all of investing, dividend per share. We're going to build this out piece by piece so you can analyze any company's dividend like a seasoned pro.
You know, it's the ultimate question for any income-focused investor, right? You buy a piece of a company, you hold on to it, but beyond the ups and downs of the stock price, what tangible cash are you actually getting back for every single share you own?
Well, the answer is dividend per share, or DPS for short. This is the metric that cuts through all the noise. See, it's not about hypothetical value, it's the specific, declared cash that a company puts back in your pocket for each share you hold. We're going to use this as our governing thought for the entire analysis.
So here's our roadmap for today. First, we'll cover the core concept, what DPS is. Then we'll get our hands dirty with the actual calculation. After that, we'll shift into analysis, what the number is really telling us. We'll look at some real-world case studies, and then we'll finish up by building out your complete investor toolkit. Let's dive in.
All right, let's kick things off with part one, the core concept. Before we can analyze DPS, we have to be absolutely crystal clear on what it is and what it represents. So the definition itself is pretty simple, but don't let that fool you. It's incredibly powerful. We're talking about the total cash a company pays out over a period, say a year or a quarter, but then it's boiled down to a single per-share figure. This makes it a fantastic tool for comparing the direct income you'd get from different investments side by side. And this, right here, is the so what. A company can't fake paying a dividend. It takes real, actual cash. So a steady or a growing DPS is a powerful, tangible signal that a company is not only profitable, but it's also stable, and maybe most importantly, it's dedicated to rewarding the people who own it. That's you, the shareholder. Okay, on to section 2, the mechanics. Knowing the definition is a great start, but a true analyst, well, they understand how the number is actually put together. Now, what's really interesting here is looking at both parts of this simple fraction. Up top, in the numerator, we subtract special dividends. And why do we do that? Well, because those are one-time events, and what we're really trying to measure is the regular, repeatable cash return. But just as important is the denominator, the shares outstanding. If a company is buying back its own stock, that number goes down, which can actually boost the DPS even if the total cash paid out stays exactly the same. It's a key detail to watch out for. Let's make this real with a quick example. So imagine a company paid out a total of $237,000 in dividends. But if you look closer, you see that included a one-time special dividend of around $59,000. So we subtract that out to isolate the regular, sustainable dividend payment. Then we simply divide that by the 2 million shares the company has outstanding. And there's our number. 9 cents per share. That is the sustainable, repeatable cash return that this company provided to each of its owners last year. Simple, clean, and you know what? Incredibly insightful. So here's the crucial point. We've calculated the what, but now we need to understand the why. What is this number truly signaling to us as investors? This is where we shift from being a mechanic to becoming a true analyst. Think of this as your consultant's diagnostic checklist. A rising DPS, it signals strong profitability and cash flow. Again, you just can't pay with cash you don't have. It shows a clear commitment to shareholder value, proving the board is focused on returns. The consistency, or maybe the lack of it, reveals the company's official dividend policy. It's also the essential foundation for calculating the dividend yield, which we'll get to in a bit. It tells you about the company's maturity. Is it a stable player or a growth company that's reinvesting all its cash? And finally, it helps you assess the reliability of future income from that stock. So how do these signals play out in the real world? Theory is one thing, but looking at case studies is where the analysis really comes to life. You know, when you chart the DPS of a healthy, mature company over time, you often see this beautiful stair-step pattern. It's this perfect visual representation of consistent, reliable growth in shareholder returns year after year. Take a look at Coca-Cola, a classic example. You can see that steady stair-step growth for years, right from about 12 cents in '96 to 51 cents by mid-2012. But then, whoa! Look at that last quarter of 2012. The dividend gets cut in half? What happened? Did the business suddenly fall off a cliff? And here's the twist. That drop wasn't a sign of trouble at all. It was the result of a 2-for-1 stock split. See, for every share an investor owned, the company gave them a second one. So while the dividend per share was cut in half, the total cash in their pocket remained exactly the same. It's a perfect example of a crucial lesson. In analysis, context is everything. This kind of long-term consistency is exactly what earns companies like Coca-Cola and Walmart a very special title, dividend aristocrats. But what about the opposite? A dividend cut can be one of the strongest negative signals a company can send. It often means the company is in distress. Its profitability has fallen so far, it just can't afford to pay anymore. It tells you that reliability of future income signal we just talked about is flashing bright red. That's the anti-aristocrat.
Okay, let's bring it all home with our final section, the application. DPS is a fantastic metric on its own, but it becomes even more powerful when you use it as part of a complete investor's toolkit. Two key related metrics are the payout ratio and the retention ratio. And really, they are just two sides of the same coin. The payout ratio tells you what percentage of the company's profits are given back to you as dividends. And the retention ratio, that tells you what percentage is kept by the company to reinvest for future growth. Understanding this trade-off is absolutely key to understanding a company's strategy. And this also shows how DPS can be predictive. Advanced valuation methods like the dividend discount model actually use the current DPS as a starting point to project all of a company's future dividend payments. This shows that DPS isn't just a historical number. It's a fundamental building block for figuring out what a stock should be worth today. This brings us to the ultimate bottom line question. We've learned how to calculate it and analyze it, but what numbers should we actually be looking for? What makes a DPS good?
And the classic consultant's answer is, it depends. The key is to look at it in context. While a dividend yield, which is just the DPS divided by the stock price, between 2% and 6% is often considered a healthy benchmark, you just can't compare apples to oranges. A mature utility company is going to have a very different dividend profile than a high-growth tech company that's reinvesting every single dollar it makes.
So here's the key takeaway. DPS is a vital metric, but it's not meant to be used in a vacuum. The most effective investors analyze it as part of a dashboard, right alongside the dividend yield and the payout ratio. That's how you get a complete, holistic view of a company's financial health and its shareholder return policy. So there you have it, the framework to analyze a company's cash return with the precision of a top-tier consultant. The only question left is, which dividend aristocrat will you investigate first?